Imagine this. A developer has not built a single unit yet, but has already made tens of millions. Most people think the money in real estate is made through construction and sales. But in Saudi Arabia, some of the biggest profits are created long before a project even begins. And if you don't understand how deals are structured, you can't understand where the real value is actually created. In this video, I'll break down how developers structure deals, where the biggest risks are, and what are the exit strategies, all through real-world examples. Let's start with the most important concept. Developers don't create the most value when they sell a project. They create it when they buy the land and structure the deal correctly. Here's a simplified example. If land is acquired at 1,000 riyals per square meter, its value can increase to approximately 1,500 to 1,800 riyals per square meter after rezoning, as well as infrastructure planning and development. In simple terms, a piece of land on the edge of Riyadh may seem inexpensive today, but if major projects are planned in the area, for example, new infrastructure, metro lines, highways, or retail developments, the value of that land can rise dramatically, in some cases within just a few months or years. And by the time the project launches, the developer may have already created a 50 to 80% uplift in land value. This is called value creation through positioning, not construction. And in many cases, this is where a large portion of the profit is actually made. Now let's look at how developers execute. There are two main models. The first model is built to sell, where residential units, as an example, are developed and sold either off plan or shortly after completion in order to generate faster cash flow. To put this into perspective, if a project's total cost is 200 million riyals and total sales value is 260 million riyals, then profit is 60 million riyals, approximately a 30% margin. Whereas in build-to-hold model, a developer simply develops and retains assets, then generates rental income. For example, if development cost of a project is 150 million riyals and the annual rental income is 12 million riyals, then yield income is approximately 8% annually. The reality is that the choice will largely depend on market conditions, regulatory shifts, financing costs, and long-term strategy. And for investors, the same dynamics often determine where the strongest opportunities and the biggest risks actually exist. If you want a deeper breakdown of where capital is moving in Saudi real estate right now, watch this video next. This is where real deals get more complex, as most projects are not fully funded by developers' equity. So, a typical structure is 30% equity injected by the developer and/or investors, and 70% debt, which is bank financing, in addition to off-plan sales used to fund construction in certain residential projects. Let's take an example for a project that costs 300 million riyals. This means that equity is 90 million riyals and debt is 210 million riyals. So if the project generates a profit of 60 million riyals, the return on equity becomes approximately 67%, or 60 million on 90 million riyals. But there is the important part. Leverage can increase profits very quickly and destroy a project just as fast if not properly structured and managed. That leads us to where many developers fail when they do not have proactive management of 4 key risks that can quickly turn a profitable project into a struggling one. Misreading demand that makes developers invest in the wrong product, in weak locations, or at the wrong time without having the flexibility to adjust their plans according to market conditions. Cost overruns, which is construction cost inflation and delays in project execution. Slow absorption, where units are not selling as expected, leading to cash flow pressure. And poor planning for post-construction, that is the management of operations, project facilities, and master community. This is why execution matters more than assumptions. A successful project is not only about development, it's also about having multiple ways to exit the deal. Developers don't always sell everything immediately. Instead, they usually have multiple exit strategies depending on market conditions. One option is traditional unit sales to retail buyers. Another is bulk sales, where large portions of a project are sold to institutional investors for faster liquidity. Some developers use private funds or the publicly traded REIT funds, which help to monetize income-generating assets. And in some cases, developers simply hold assets long-term to generate recurring rental income. The best developers are those who stay flexible and adapt their exit strategy to the market. Today, the Saudi market is offering bigger opportunities, but also demanding much greater precision. The development model is evolving as financing costs are higher than usual. Buyers are more selective and supply is increasing. At the same time, we will observe large-scale development and, most importantly, government-backed projects remain active. This means that margins are becoming tighter and only well-structured projects will succeed. The deeper you look into real estate development, the more you realize it's not only a construction business, it's a business of timing, capital allocation, and execution. The real advantage comes from understanding where demand and opportunity are heading next. That leads us to the topic of my next video, where we'll talk about the biggest risks that can still destroy a project and which developers are actually prepared for the next cycle. If you want to follow this breakdown in real time, subscribe and stay connected. And if this gave you a clearer understanding of how the market really works, share it with someone involved in real estate. If you're working on a specific project or investment decision, you can reach out directly at landcapital.sa@gmail.com for a focused discussion. I'll see you in the next one.